Silver is touching levels most people were told they would never see. Gold is pressing historic boundaries, and yet something far more important is happening beneath the price. While headlines scream top, while institutions whisper reversal, a deeper signal is quietly forming, one that has preceded every major monetary shift in modern history. This isn't about hype. It isn't about charts. It isn't even about silver itself. It's about what happens next when trust starts moving faster than capital, and why those who misunderstand this moment may never get another chance to reposition, because once this realization spreads, the window closes. Welcome to Boring Currency Index. Now, before we go any further, allow me to ask you something, respectfully. Like I would ask someone with decades of life experience behind them, if you've lived long enough to see currencies change, promises break, and systems reset, then subscribing isn't a trend. It's simply staying informed. So take a moment, subscribe, and stay with us. And one more thing. Tell us in the comments, from where in the world are you watching this today? As global markets opened on a tense Friday morning, silver stood just below a symbolic threshold. Prices hovered near levels that, for decades, were considered impossible. To many observers watching from the outside, the conclusion felt obvious. Silver had gone too far, too fast. The rally, they believed, was ending. In traditional finance circles, this reaction is almost automatic. When an asset reaches a round number or a historic high, analysts are trained to look for exhaustion. They search for signs of excess, speculation, and emotional buying. In stocks, this method often works. In monetary assets, it frequently fails. Silver is not behaving like a growth stock or a speculative technology play. It is responding to forces that most valuation models are not designed to measure. Yet many market participants insist on applying the same logic they use for equities. They look at price alone and assume that height equals danger. This is where the first and most common error appears. In equity markets, late attention usually means late risk. By the time the public notices a stock, much of the upside is already gone. This pattern has trained investors to fear popularity. When silver enters mainstream discussion, it triggers the same reflex. People assume the move must be near its end, simply because it is now visible. But visibility does not equal completion. Silver remains a small, thin market compared to global equity and bond markets. Even large price moves do not require mass participation. What appears dramatic on a chart may still represent limited capital flow in real terms. This distinction is often overlooked by those unfamiliar with monetary assets. Another misunderstanding lies in the word speculation. In traditional markets, speculation is driven by future earnings expectations. In silver, price moves are driven by present conditions. Rising prices do not reflect hope for growth, but concern over stability. This is not forward optimism, it is present doubt. When trust in currencies weakens, silver does not rise because people expect profit, it rises because they seek protection. This changes how tops form and how long trends persist. Those calling the peak often assume silver is reacting to excitement. In reality, it is reacting to erosion. Confidence does not vanish in a single moment. It declines in stages, often quietly at first. This is why early judgments are dangerous. A high price does not signal an ending. In monetary cycles, it often signals recognition. And recognition, historically, has not marked the end of the move. It has marked the beginning of acceleration. Ever wonder why trying to value silver with traditional metrics is like trying to catch a fish with a butterfly net? It just doesn't work. Most assets, like stocks or real estate, are valued based on what they produce: dividends, rent, profits. But silver plays a completely different game. Its value isn't about productivity, it's a barometer for trust. When people lose faith in currencies, governments, and the entire financial system, they turn to tangible assets. Think of silver as a financial panic button. As trust in the system erodes, the price of silver doesn't just climb, it skyrockets. It's not reflecting its own output, but rather the cracks appearing in the foundations of our economic world. So, next time you see silver prices moving, don't ask what it's producing. Ask what's breaking. Thanks for watching, and don't forget to subscribe for more insights. Financial models are built on gradual change. Forecasts assume steady trends, predictable reactions, and time for adjustment. These assumptions hold in productive systems. They collapse when belief itself becomes the variable. Silver operates in the second realm. Unlike businesses, which grow through planning and execution, monetary assets move through realization. When people collectively recognize that something is wrong, value shifts do not wait for quarterly reports or policy confirmation. They move at the speed of thought. This is why silver's behavior often feels sudden to outside observers. Prices appear calm for long periods, then rise sharply with little warning. The move seems irrational only because the underlying process is invisible until it is complete. In monetary cycles, change does not distribute evenly over time. It compresses. At first, only a small group reacts. These participants are usually dismissed as early or extreme. Their actions do not move price much because confidence in the system remains broadly intact. This phase creates the illusion of stability. Then conditions tighten, debt expands, policy credibility weakens, small failures accumulate. None appear decisive on their own, but together they erode certainty. During this stage, silver begins to rise steadily, though still quietly. The final shift occurs when recognition spreads. At that point, repricing accelerates not because fundamentals have changed overnight, but because perception has. Once enough participants reach the same conclusion, the market moves faster than analysis can keep up with. This is the phase most often mistaken for instability or excess. Observers call it a spike. They assume emotion has replaced logic. In reality, logic has simply arrived late. The price is catching up to what many have already accepted internally. Speed in silver is not driven by speculation. It is driven by synchronization. When beliefs align, the market responds instantly. This dynamic explains why reversals are rare during active monetary repricing. There is little incentive to sell when the underlying concern remains unresolved. Without restored confidence, selling pressure stays weak. For decision makers, this creates a dangerous blind spot. Linear models predict slowing momentum. Experience in equities suggests exhaustion, but silver does not follow these rules. The faster it moves, the more likely it is that realization is spreading, not that the cycle is ending. Understanding this difference is essential. In monetary markets, speed is not a warning sign. It is often confirmation that the process has entered its most decisive phase, and once that phase begins, it does not pause for late reassessment. When markets enter unfamiliar territory, serious analysis turns to history, not for prediction, but for orientation. Silver's past cycles offer one of the clearest guides for understanding its present behavior, provided the comparison is made correctly. The mistake many observers make is focusing on price levels rather than returns. Dollar figures create emotional reactions. Percentage moves reveal structure. In previous silver bull markets, especially during periods of monetary stress, the pattern was consistent. Early gains were modest. Mid-cycle advances attracted attention. The largest moves arrived near the end when confidence in the system deteriorated fastest. This sequence matters. During the late 1970s, silver did not rise steadily. It accelerated. Months of gradual appreciation were followed by rapid repricing in a compressed time frame. Those watching from the outside labeled it irrational. Those inside the monetary cycle understood it as a response to collapsing trust. What stands out is not the final price, but the scale of the move relative to where it began. Silver multiplied several times over in a short window, not because production changed, but because perception did. This historical pattern challenges modern assumptions. Many believe large percentage gains must come early in a trend. In monetary assets, the opposite is often true. The most dramatic returns tend to occur when belief shifts from doubt to recognition. Applying this framework to the present removes much of the confusion. Today's price action mirrors the structure of past cycles, not their conclusion. The market has moved from neglect to discussion, but not yet to full participation. That distinction is critical. History does not repeat in exact form. Conditions differ, scale differs, but behavior rhymes. The sequence, dismissal, gradual repricing, acceleration, has appeared before. For entrepreneurs and capital allocators, this historical context serves as a warning. Waiting for clarity often means waiting until opportunity has passed. In monetary cycles, resolution arrives only after repricing is complete. Silver's current phase does not resemble an ending. It resembles the point at which past cycles became unavoidable. History suggests that once this stage is reached, the market does not reverse because skepticism remains. It completes its function, reestablishes a new reference point, and only then stabilizes. The lesson is not to chase history, but to understand it. Those who ignore historical structure risk repeating historical mistakes, watching transformation unfold from the sidelines while believing it is already over.